Stocks trade ranged as valuation concerns scare off with expectations of an investor-friendly budget. FMCG and capital goods notch up gains, while consumer durables and realty drag.
Titan slips after reporting a below-par performance in Q1 on the back of weak demand. Analysts also fret over pressure on its margins.
FMCG stocks gain after Marico reports an uptick in volume growth and Dabur cites improved demand in rural India. IMD's forecast of better than normal July rainfall also aids sentiment.
It is the end of pre-budget consultations at North Block as the finance minister readies to present the union budget on July 23rd, and adherence to fiscal discipline, continued capex push and boost to rural and urban consumption are among the key expectations.
Hello and welcome. You're watching us here on Halftime Report on CNBC-TV18. I'm Mangalam Malu. Joining me today is Ekta Batra. Comes back after a break, Ekta, and what have you brought back with you? Markets in the red. All of last week, we were seeing good gains coming by, and maybe it's the good gains which actually have, led to some bit of profit-taking, some bit of consolidation, pretty much par for the course. And ahead of the big events, we have the IT results, we have the budget, all of that. So maybe before that, consolidation not particularly bad.
Hi, Mangalam. Yes, absolutely. I think, we need to get a little bit of a reality check sometimes. And too much of a good thing is probably not a good thing. So, yes, profit taking is what we are saying. The markets have started the week in the red. And in fact, just to put it into perspective, the markets have gained for the 5th straight week. It's the longest winning streak that we've seen since December of 2023. So really, who is complaining at this point in time? Markets, like you mentioned, are going to be focused on the two big events which will be taking place, which is Q1 FY25 earnings. And that's going to be kicked off this week itself with TCS as well as HCL Tech. And then 23rd of July, which is a Tuesday, we do have the budget, which is around 2 weeks from now. So I think the street will be squarely placed in terms of cues coming in from these two big events, which will continue through July. But nonetheless, we have a lot of stocks in focus.
A lot of stocks in focus. So let's start with a lot of these updates, because when we get the Q1 results, before that, it is the result preview season, and that's exactly what is taking place, especially from the BFSI and FMCG space, along with real estate, etc. So let's get in BFSI first. Bank of Baroda lower in trade, AU Small Finance Bank lower in trade, both of them down by about 3 to 4%. Abhishek joins in with the updates of that one. Abhishek, how do they look?
Well, to begin with Bank of Baroda, on a sequential basis, if you take a look, deposit and advances growth are the weakest in last 12 quarters. And they have lost market share as well because their YOY numbers are below the industry level growth. So take a look at the deposit momentum. It's up 8.8% YOY and a decline of 1.6% sequentially. Industry-wide, deposit growth in June was around 12% level. Domestic deposit is further weak. It's grown by only 5.3% YOY and down by 2% sequentially. The advances growth are about 8% YOY when compared to industry growth of 15-16% on a YOY basis as of Q1 that the banking sector has seen, and it's declined by 1.7% sequentially. In this, the domestic growth is about 8.5% YOY and down by 1.8% sequentially. In the domestic loan book, the retail portfolio grew really strong at 20.9% YOY and about 3.5% sequentially. So overall, the CD ratio has declined both YOY and quarter-on-quarter, and the domestic CD ratio, however, has improved YOY and quarter-on-quarter due to the decline in deposits. AU Small Finance Bank now, deposit growth is weak over here. Deposits have declined on a sequential basis. However, cost of funds have improved for them for the first time in many quarters. So deposits are down 0.5% quarter-on-quarter. We cannot compare the YOY numbers because there is a merger that's based into effect with respect to AU Small Finance Bank in this quarter. Cost of funds have declined by 7 basis points sequentially to 7.03% when compared to 7.1% in the previous quarter. Overall, AUM growth is at 3.5%, while the advances growth is a strong 5% growth. So if you take a look, calculate the CD ratio, that's on the higher side at 93% plus, so which leaves analysts with the worry that there will be further hike or growth for deposits, which can put pressure on the net interest margin. CASA is up 2.7% quarter-on-quarter, and CASA ratio has improved to 33% versus 32% in the previous quarter. Back to you.
Okay, all right, Abhishek, thanks very much for that. So both those stocks are down and out in today's trading session post those Q1 updates. But DOMS Industry is in focus after Axis Securities has initiated coverage on the stock with a buy rating. Upasana is following the story. She joins in with more details on what Axis likes about DOMS.
Thanks so much for that. Axis Securities has initiated coverage on DOMS Industries. It says that Indian stationery and art material market has seen continued growth over the years, and it is expected to grow at a 13% CAGR over FY23 to FY28. DOMS Industries has emerged as a leading player in the Indian stationery market, holding an overall market share of 12% in FY23. It expects companies' EBITDA margin to be in the range of 17 to 18% for FY25 to FY27, driven by various factors such as increased capacity utilization, improved product mix, stable raw material prices, and improving on-ground execution. In terms of ROC, the brokerage says that it is likely to improve from 22% in FY24 to 25% in FY27. It also expects a robust revenue CAGR of 25%, EBITDA CAGR of 26%, and PAT CAGR of 28% over FY24 to FY27. It also says that with improved visibility in earnings growth and a strong return profile, the stock appears attractive in the mid-cap space. Hence, the brokerage initiates coverage on this stock with a target price of 2,670 per share.
All right, Upasana, thanks a lot for that. That's about DOMS up around 1%, but has been a big mover ever since its listing. But power utility stocks are in focus as well, on the back of notes coming in from brokers. And today we have one coming in from Investec. Vivek joins in with the details of that note. Vivek.
Well, that's right. So today, Investec has come out with a very interesting note on the entire power utility space, especially the renewable side of the power sector, and also power EPC players. They believe that they too will stand to benefit on India's increased focus as far as increasing power capacity is concerned. So what is it that Investec says? They're saying that they expect power demand to remain strong. They see demand growth at a CAGR of 6.2% between FY24 to FY32. What is growth driven by? Rising urbanization, increased usage of AC amongst rising temperatures across India, and also enhanced manufacturing as well as economic activity. Now, what is India planning to do? India is planning to increase its total capacity to 727 gigawatts. So that indicates that India will be adding close to 286 gigawatt of new capacity by FY30. This includes both thermal as well as renewable. So what are the stocks that they have initiated coverage on, given the fact that India plans to go ahead and increase its renewable capacity a lot higher? The first stock on the radar is NHPC. They believe that the company's capacity addition is on track to go ahead and reach 14.2 gigawatt by FY27. They see consolidated regulated equity rising to 32,810 crore in FY27 versus just around 15,000 crore in FY24. The second stock on the radar is from the wind energy space, that's Inox Wind. So they have a positive rating there as well. They see that the company is well positioned to benefit from the revival across the wind sector. They see 10 to 12 gigawatts per annum of wind bidding that could happen, and Inox Wind is well poised to gain from that particular phenomenon as well. The third stock is from the EPC space. So Kalpataru Power Transmission, they believe that the company is well placed given the fact that it's a prominent EPC player with strong presence in both domestic as well as international market. They're expecting EBITDA as well as PAT to grow at 23 and 33% CAGR respectively over FY24 to FY27. KEC International, similar line of business, but having a lot of presence in the power T&D. What they're saying is that they expect revenue growth of 13% CAGR between FY24 to FY27, and the bid pipeline over here is quite strong. Lastly, JSW Energy, they're quite positive on the company's prospects, especially going forward in terms of capacity addition. But at the current market price, they believe the valuation captures most of the upside.
Okay, interesting view there. Thanks, Vivek, for that. Well, we need to take a short break, but a lot more lined up. In fact, we will be talking to the management of Mayur Uniquoters to discuss their business outlook, their FY25 guidance as well. Stay tuned for that. Welcome back. Well, a bit sluggish for the markets at this point. So we have the mid-cap index, which is down around 0.5%. We have the bank Nifty, which is down around 0.5%. It's a lot about the Q1 earnings which have come through, earning estimates or, the previews really from the management. And one such space is the FMCG space. Titan is in focus on account of that, but so is Marico. Marico is largely in line in terms of the update that they released, Mangalam.
Yes, it was largely in line, but the good part was that they are indicating improvement in their terrain going forward. And that's exactly why the stock is higher in today's trading session. So if you look at both Dabur and Marico, the nature of the commentary was similar. Gradual uptick in rural demand and, high to mid-single digit sort of growth. But the reason why Marico is moving 5% versus Dabur just about 3.5–4% is because over the last 1 month or so, Marico as a stock hasn't moved. So that comparison chart, including today's move, tells you that, over the last 1 month, Dabur is up 2.5%, while Marico, despite the 5% up move that it's seeing today, is down about 1%. So as a result of which, maybe there is some bit of catch-up playing up with Marico too. They said that the domestic business posted modest uptick in underlying volume growth, and that's a positive largely because the company was showing positive uptick, but it wasn't reflecting in the revenues. This time around, there would be revenue growth, which would be in high single digit. Remember, it was in the fourth quarter where the revenue turned positive, growth turned positive for the first time, with the management looking at positive revenue growth in this year itself. Parachute coconut oil posted low single digit volume growth. Saffola oils delivered mid single digit volume growth. So that's a turnaround for that one as well. Value added hair oils continues to be under pressure, but here the company believes they will turn into positive terrain for the volumes in the next quarter itself. They expect improving trajectory in both domestic volume growth and higher realizations, which means that revenues will only improve in the remainder of this year, with operating profit expecting to grow higher than the revenue, which implies margin improvement as well. So things are improving, margins are improving, as well as the outlook is positive. Club that with the underperformance of the stock, that means there is a bit of an uptick that we're seeing on Marico.
Okay, all right, Mangalam, thanks very much for that. So that stock is up around 5% odd. But let's shift focus to one particular company, Mayur Uniquoters, which in fact works in the technical textile industry, manufactures artificial synthetic leather for a wide variety of applications as well. The stock in fact has gained around 16% in 2024, and the company expects top line growth of 20 to 25% in FY25. Suresh Kumar Podar, who's the CMD and CEO of Mayur Uniquoters, joins in now to discuss the FY25 guidance with us. Mr. Podar, welcome to the show. Well, just wanted to ask you about your 20 to 25% growth guidance that you have for FY25. What makes you so optimistic, considering that you did not manage to meet your FY24 guidance? Which I think was around 12 to 15%, whereas you eventually reported, I think, around a 4% growth.
Yeah, actually, in 23-24, there was a big problem in footwear industries. You must be knowing that India government is going for BIS specification for all the imports from all over the world in certain areas. Whereas in our footwear and footwear products, they put up BIS. So that's why the footwear sales is very, very down this year, last year, 23-24, especially second half. It was just down by 50% because nobody is able to keep the stock. Because if they keep a stock and they can't meet BIS, then their stock will be out of date. So now the government has increased the 6 months timeline, and we have got a big discussion with government's different department. And I hope this year it should be better. The last year downfall was main reason was the footwear.
All right. So this year, what is your outlook? Because I remember, sir, the last time you joined us, you did say that footwear was close to around 60% of your revenues, fell down to around 30–35%. That's because footwear industry wasn't doing well. Secondly, OEM exports had increased. So where do you expect the footwear industry to be this year as a proportion of your sales? And OEM exports, what's the kind of revenue growth prognosis that you have?
You see, so far as export OEM, automotive, there is a good scope. We will grow at least 30% this year and will continue next 3 years. And that I'm telling with the orders in our hand. The every model is decided 2 years before. So from now to 2 years, we have been allotted the orders for different models. So export OEM, I am very much confident. Even BMW also we have started, and this year I expect BMW and Mercedes sales 50,000 meters in this year per month, which was there was only Mercedes-Benz which was 25 to 30%. Further,
Okay.
our export
Go ahead, sir.
Go ahead, sir.
export journal is also doing good. We expect at least 12% to 15% growth in export journal, which we are selling different product to different countries. Only
Okay.
thing which is, worrying us is the footwear industries, which way it will go. But we expect that this year should be better than last year, because we are seriously, all the automotive industry, footwear industry and footwear component industry is meeting regularly to the government department to clarify this BIS. So except footwear, I have full faith that all the others will increase. OEM domestic automotive will also grow between 10 to 12% this year. Although we have seen in the news that automotive industry is going down, but we are okay.
All right.
So this year,
can you quantify
Yeah.
Sir, can you quantify the order from BMW and Mercedes? How much do you think you'll probably make in terms of revenue from both these companies in the next 2 years? And is there a possibility of repeat orders? How long does the contract go on? Can you give us more color on these two
No,
specific
this-
company orders?
You see, these two specific companies, this is from their South Africa production. And there we have got an order for BMW, and both of them, including Mercedes and BMW, it will be 50,000 meters per month. So this is BMW and Mercedes. I'm talking about South Africa units, both. So in that, until unless we go for another Ford also, we are trying in South Africa, but we don't know when we will be able to get the orders. But from South Africa, BMW, Mercedes will be the same.
Right. You were giving us the targets for this year when it came to revenue and profit growth. Could you tell us that?
See, revenue growth, what I see, you see, always we give our revenue growth according to the market, what is going on in which segment, because we are not limited to one segment. We are working in footwear, we are working in automotive, we are working in garments, we are working in, you see, this furnishing. So sometimes something disrupt, then things become little bit different. This year, on the whole, I expect more than 15%. If footwear is good, then it may be 18%. That's what I see from today's situation.
Okay.
And margins?
Yeah.
Margin should increase little bit because export OEM, there is good margin comparatively, compared to Indian products. So
Okay.
margin may little bit because overall difference cannot be too much, maybe 1% or something like that.
Okay.
Overall.
All right. I just wanted to understand, when you talk about margins, there's not too much of an upside that you're expecting. You finished FY24 with 19.4%. What is the range that we can probably expect in FY25? You said you can't better it too much, but you go up to around 20, 21%?
Yeah, I hope so. I hope so.
What are the biggest headwinds to that?
But what I'm saying, because of we are having good order from export OEM, and there we have a better margin. so it must increase. But now if something like footwear is, big question mark, how it is going to move. Of course, it should move better, but you can say 1.5% you can expect.
You had said that footwear is about
Next
30-35% of your sales. Sir, if you could, once again for the benefit of our viewers, decode what sector contributes how much to your overall revenue?
You see, now at the moment, automotive is doing about more than 50%, 50 to 60%. And footwear has gone down to 30%. And the rest is 10%. And,
All right. And
automotive is gradually increasing, and general export is also increasing good.
all right. Just finally, before we let you go, one of the triggers was the increased utilization of your PU plant. And you've been saying that, for the last couple of years, there has been dumping coming in from China and other countries, etc. as well. In light of all of this, what is the kind of utilization expectation that you have for the PU plant in this year and the next year?
See,
All right.
Okay. All right, Mr. Podar, we're going to touch base with you again whenever we can, but that was a whole host of questions answered by the management of Mayur Uniquoters, which seems primary concern is footwear, but is extremely bullish on the OEM market. So let's see how that pans out for them. The stock absolutely flat in today's trading session. We'll take a break on that note, but up next we'll be talking to Sudeep Shah of SBI Securities with his trading ideas for today. Stay tuned.
Welcome back. You're watching us here on Halftime Report. Let's talk about the market setup at midday, especially from an F&O standpoint. If you look at the key indices, the Nifty is down about 50 points, around that 24,300 mark, just below that. The Nifty Bank is under pressure, down about 0.2%, down 300 points. And as the market has moved lower, the volatility has increased. So the India VIX is up by about 7.5%, and that's ahead of the big events as well. IT earnings starting this week, and then all the other earnings updates which are keeping the markets moving. And then you have the run up to the budget. So all of these factors work towards increasing the VIX itself. The sector of the day definitely has to be FMCG, with Marico, Dabur up around 3.5 to 4%. Godrej Consumer and HUL also in focus. Godrej Consumer hasn't come out with its update yet, but ahead of that itself, given the others, has seen a bit of a pre-buying. So that's one thing which is on our radar. But the big accident of today has been Titan, the top Nifty loser with a cut of almost 4%. It's trading below the 20, 50, 100 and 200-day moving average, and at the same time has corrected about 20% of its all-time high. Now the stock is around 31.39. It's the 3100 put which is most active for a premium of 30 odd rupees. So around 30.50 to 30.70 is where the street expects some support coming in for Titan, which would also coincide with the 20% cut that we've seen from the highs itself. So that's one stock we're keeping an eye out on. For the Nifty itself, 24,300 is a bit of a fulcrum. 24,300 put has a premium of almost 117. 24,300 call has a similar premium, close to around 100 rupees. So the broad range that the street is working with is close to 24,100 to 24,500, between 24,150 to 24,450 itself, which was similar to the high and low that we saw on Friday itself. Just one stock that I'm watching out for today is Chambal Fertilizers, likely to enter F&O ban, as JNFC did on Friday, and a couple of stocks on Thursday as well. So those are a bunch of cues coming in from the F&O space.
Okay, Manglam, thanks very much for that. Sudeep Shah, who is the head technicals and derivatives research at SBI Securities, joins in on the show now. Sudeep, hi, welcome to the show. Well, a little bit of red on the screen and an underperformance from the mid-caps as well as the banks. Do you think that would be an opportunity to accumulate at these levels?
Yeah, good afternoon, Ekta and Manglam. Last few days, from Bank Nifty standpoint, we have seen the Bank Nifty consolidating between 51,900 and 53,000 on the upside. Last 8-9 sessions to be particular. But what we are seeing is a lot of sectoral rotation now. Oil and gas, IT, FMCG, PSU, all these spaces have become more vibrant, and that is what is supporting Nifty at lower levels. And Hence, we are expecting that within this overall uptrend, Nifty could at the best consolidate between 24,100 and 24,500 and closer to 24,100, 24,150, where the 10-day exponential moving average is there. I guess buying support is there, and buying should be done at those lower levels. And we expect 24,500, 24,600 to be achieved in Nifty in the next few sessions.
Okay. All right. And stocks, what would you choose today?
So there are a couple of stocks, one from the FMCG name, which is Godrej Consumer Products. Now, the stock was in a steady uptrend, and in the last 10 to 12 sessions, it was consolidating between 1350 and 1415, 1420. Today, we are seeing a downward sloping trendline breakout, as well as the stock has sustained above its 10 and 20-day exponential moving average since last 8 to 10 sessions. So what we are seeing is, with this overall momentum back in FMCG, Godrej Consumer Products stands to gain, and it's outperforming its own index also. So this can be bought with 1390 as a stop loss on the downside and 1460 as a target. The second stock that I like is oil and gas, ONGC. So within the oil and gas space, this stock has outperformed, and it has given a 6-month consolidation breakout today. So within an overall uptrend, post a consolidation, a strong breakout backed with volumes, the stock could do 305, 310 in the next few sessions, and this could be bought with a stop loss at 287 on the downside.
Okay, all right. I just wanted your opinion on a couple of stocks today, which is seeing some good amount of volume and price action. So Paytm would be one of them. That stock is up around 7-odd%. IFCI, IRFC, all of these stocks are managing to buck the trend. Obviously, IFCI and IRFC are building on the gains that we've seen on a year-to-date basis. But technically, any kind of approach towards these stocks along with Paytm?
Yeah, so starting with Paytm, Paytm has been in a consolidation range right from February, after that big fall from 950 to almost closer to 325. Post that, in the last 6 months, the stock was in a range between 440 and 350 on the downside, and today we have seen a consolidation breakout on the upside. So although it's overall, the stock is in an overall downtrend, but there could be a rebound from these current levels, and till 440 holds, this rebound could continue up to 520, 540 kind of zone. So yes, from a short-term perspective, this is a buy, but from a medium-term perspective, closer to 550, closer to 600 levels, one should consider exiting this stock, as the overall trend is on the downside. The second stock which you mentioned was IRFC. Now, IRFC also similarly with all the railway stocks, the kind of momentum that was built in the last few sessions. Today, we have seen post Friday's move, we have seen a buildup of momentum there also. And overall, if we see, the stock is doing good, and I guess from the current levels also, this can hold out until 194 holds. IRFC can continue its positive momentum up to 210, 215 levels in the coming few sessions.
All right, take that point. Thank you so much for joining in and giving us your views, Sudeep. With that, we'll slip into a short break. But before we do that, let's keep an eye on a couple of stocks. Kaya is one of them. Kaya has been on a big upper circuit sort of spree for the longest time, and ever since it's announced its deal with Marico, a collaboration, the stock has consistently been hitting upper circuits itself. Today opened lower, but that too was bought into, and we've seen a 10% up move on Kaya. So if you pull up this month's chart itself, you know, Kaya would be up close to around 36%. And this year itself so far, which is 2024, the stock is up 80%. Take a short break, come back, get you more on the markets and more particularly the FMCG space. Anuj Sethi, who's the Senior Director at CRISIL, joins in to discuss the trend of the sector of the day, which is FMCG. Welcome back. Reliance has moved to the high point of trade. Remember, on Friday as well, Reliance was the one that led the recovery of the market. So let's see whether this can keep up and continue to take the Nifty off lows as well. So right now, just keep an eye out on this heavyweight, even as the Nifty Bank is down 300 points. The FMCG sector is definitely the sector of the day, with a big up move coming by on the back of updates coming in from Dabur as well as Marico, and indicating gradual recovery in this year itself, particularly from the rural end of things. That coincides with a bunch of brokerage reports that we've gotten as well, analyst estimates too. One of them is actually CRISIL, which sees a revenue growth of 7 to 9% for the FMCG sector in FY25, led by volumes and mildly some realizations as well. Of course, underlying the revival in rural demand and steady urban demand as well. We do have with us Anuj Sethi, the Senior Director at CRISIL Ratings, joining in now to give us a detailed outlook on what they expect from the FMCG sector this year. Thanks a lot, Anuj, for joining in. The first quarter updates are in. There are signs of recovery, but if we had to put a number to that recovery, 7 to 9% is the revenue growth that you're targeting this year for the sector. Could you break that up in terms of volumes and price, and what sectors or what categories are likely to outperform?
Sure. Good afternoon, Mangalam and Ekta. We expect similar to last fiscal, this fiscal also the growth in the FMCG sector will be largely driven by volumes. To break it up, almost 6 to 8% of the growth will come from volumes and about 1 to 2% from realizations. And in realizations also, it will be driven largely by minor price hikes taken in certain categories to pass on, the price of milk, wheat, sugar, which has gone up, and also higher marketing and ad spends, and also the premiumization game, which is being played in some of the segments.
Okay. Can you break up the growth, the segments in terms of growth, for example, F&B, personal care as well as home care segment? What are you expecting in terms of growth within each of these segments? Where do you expect an outperformance and an underperformance, and why?
Sure. See, if I to break it up, the home care and the personal care, these two together account for about 75%. Of course, home care would be almost 50%. And the last segment would be the personal care, which would be around the balance 25%. We expect both home care and food and beverages will grow at about 8 to 9%. The reasons could be different. The home care would be largely led by urban demand. And this is a segment which has been outpacing all segments in the recent past. The food and beverage segment will also be driven by a revival in urban demand. The rural demand. We saw that already since the last quarter of fiscal 2024, where actually rural demand outpaced urban demand. And that was true of the food and beverage segment as well, which is the largest segment, almost accounting for 50% of the revenues. We don't see any segments per se underperforming. Even the personal care segment, which is expected to grow at about 6 to 7%, is slightly slower than the food and beverages as well as the home care segment. But one must realize that even this segment is almost doubling its growth rate compared to last year. The personal care segment is highly penetrated, and there is also downtrading happening in certain segments, which started during the period of high inflation. But even that segment we expect to grow at about 6 to 7% this year.
For the sector at large, what's the kind of margin growth that you are anticipating? And in that, what do you think are the categories that will see the highest margin expansion? Because you are also penciling in margins being limited by the increase in ad spends, etc., which we've seen all of last year. This year, what's the kind of spend increase that you foresee?
Yeah. See, if you look at the ad spends per se, as a percentage of sales, they went up by almost 100 bips last year. We are anticipating another 25 to 30 bips increase on the increase of last year, which will, constrain significant margin expansion. And why this is being done is because there is intense competition, plus a bit of down trading, which is also happening. Having said that, we see the home care segment where the margin expansion will be the largest, because that is largely driven by the urban demand. This will be followed by the food and beverage segment, and lastly, the personal care segment.
Okay. Anuj, I know you can't talk stocks, but just wanted to get a sense from you in terms of, what happened with Titan, where the standalone sales growth was at around 9%. It was below estimates of around 11% odd. The jewelry sales also missed estimates. The street is worried about demand as well as the high gold prices probably impacting the segment. Do you think that's a temporary blip, or is that something that you think would probably be something that you would monitor for the rest of the fiscal as well?
We'll talk about the retail sector in general. What we saw clearly, especially in some of the discretionary-led spend, was that there was some postponement because of high prices. For example, in jewelry segment, gold prices peaked at their all-time high in the quarter. Of course, they've also come down, but that did put off some of the purchases are postponed. Secondly, if you look at it vis-a-vis last year, the first quarter of last year, this year, in the first quarter, there were only 5 or 6, auspicious wedding dates, which means that the wedding season also is getting pushed a bit to the next and the third quarter. So this is also one of the reasons why the retail sector got a bit impacted, in the first quarter. And this is true also for some of the wedding-led apparel and not just jewelry.
And finally, before we let you go, I wanted you to tell us about, large players versus emerging players, the competition that you're speaking about. Because typically what happens is during inflationary times, the larger players gain market share. As inflation abates, the smaller players start to undercut the larger players and then, try to claw back their market share as well. So in light of that, this year, how do you fare the larger players will do versus the smaller players, unorganized sector, and some of the mid-tier companies as against the larger companies?
I think what has happened in the FMCG space, especially, is that in 22 and 23, when inflation was a bit high than what it is now, we did see a bit of downtrading happening and consumers shifting to more the mid-sized and certain state-focused FMCG players. That is now changing since last year because inflation has moderated a bit, and we are seeing the strategies adopted by the larger players so playing fruit. Clearly, I mentioned the 100 bips expansion in ad spends being one of them. So we will expect that there will be a better growth seen by FMCG players overall, and large players should continue to consolidate their position in a lot of categories. Of course, food and beverage will remain the most competitive, and here is where the mid-size and the state-focused players also have emerged pretty strong. But other two categories, the home care and personal care, is where we see the larger players gaining more share this year.
Okay, all right, Anuj, we're going to leave it on that note. Thanks very much for joining in and giving us your perspective on the FMCG space, which seems to be the flavor of today's trade in terms of news at least. Just a quick check on the markets, quite unchanged you'd have to say at this point. So we have the Nifty, which is at around 24,278, down around 44 odd points. Bank Nifty, which is a little bit of an underperformer today, is down around 0.6%, showing a cut of around 300 odd points. Take a short break, but we'll focus on Shilpa Medicare next, which has been in focus on account of news. It's trading in the green post its conference call that it held at 11 a.m. today on the back of a CDMO opportunity. We'll be back with that.
The one sector which doesn't seem to stop rallying is the rail space, because we're seeing a big move in names like RVNL and the others, all of them spiking. And the other one is the shipping space as well. All of last week we saw gains of almost 20 to 30% in names like Mazagon Dock, GE Shipping. Well, start off Monday with a big gain on GE Shipping as well, up close to around 7%, taking this month's gains up to around 11-12% itself. Mazagon seeing some bit of profit taking, but remember, was up around 30% all of last week. Shilpa Medicare is the other stock on our radar. The company held an analyst call with an update coming in on their CDMO arrangement. Ekta, you heard into that call. What were the key takeaways?
Well, it's specifically on one particular NCE, which they are new chemical entity, which they've signed with a company. Now, they are expecting, and this happened last week, but they held the call today to apprise investors and, answer a lot of the questions that a lot of people had. So they expect orders for 5 million tablets for this particular CDMO opportunity before June 2025 and an additional 15 million tablets before December 2025. This particular molecule in question is used to treat increased phosphate levels in kidney patients. Now, in this particular molecule, which is OLC-NCE, NCE stands for New Chemical Entity, one has to take only 2 tablets a day. And currently, other phosphate binders which do the same thing, a person has to take 8 tablets a day. So that's the kind of opportunity from this particular drug. The pricing decision will eventually be decided by the pharmaceutical company itself, and they will be filing for the drug in the US initially. So that's the only market that they'll be focusing on, and then eventually global markets. The phosphate binders market size in the US is around $1 billion. Now for Shilpa, they will be getting a signing, approval and launch milestone. $10 million is the cumulative milestone fee that they will be getting. Supply should begin from Q1 FY26. The current agreement is exclusive and is for 4 years. They will have an opportunity to renew it, but that will come with certain riders. They expect margins of 50% and above from this molecule. So whatever sales they make, they're expecting 50% plus margins on those sales. So that's the kind of opportunity that we're talking about. Let's see whether that comes through or whether there are any kind of roadblocks. We expect substantial revenue from this, and the capex is going to be funded by the pharmaceutical company in question, and that will be around $6.5 million. It should be up in a year. Till then, they will be supplying from their existing facilities.
All right, take that point. Thank you so much for that, Ekta. That's about Shilpa Medicare. But Tata Motors, among the top Nifty gainers today on the back of their JLR business update coming in. Sonia joins in with all the details. Sonia, looks good.
It does look good actually. So it's a decent set of numbers coming in from Tata Motors. Single-digit growth for JLR overall. But if you look at the retail sales data, ex of the China JV, it's in double-digit growth, and overall retail sales is up almost about 9%. Now Tata Motors' stock has also been performing quite well. So if you look at what brokerages are saying, right, across the board, whether it's JP Morgan, whether it's Macquarie, brokerages continue to be very positive. JP Morgan has an overweight. They have a target price of 1115 on Tata Motors. While if you look at Macquarie, they say that the product mix for Tata Motors has improved substantially, and hence they too have a positive rating. Macquarie has an outperform with a target price of 1171 on the stock. Back to you.
All right. Thanks a lot for that. And as we speak, there are some more updates coming in from Tata Motors as well. This is about global wholesales. But we'll take a short break, come back on the other side. Manisha Gupta, as always, joins in with all things commodities. Today, she has with her Surendra Mehta, who's the secretary at India Bullion and Jewelers Association.
Welcome back, and joining us on the show now is Surendra Mehta. He's Secretary at India Bullion and Jewelers Association. Mr. Mehta, I thank you so much for joining us. And, we know the results for many jewelry companies are out now, and we do know that the numbers are not so strong for the previous quarter. Now, this quarter is when we see the wedding and the festival season come in. The other festival clearly is going to be the budget as well, and the expectations that you could look at some cut in duty is keeping some of the buyers sidelined. How high do you see it as a probability of a duty cut coming in for gold, silver, platinum, diamonds, all of that sector?
See, as far as gold and silver is concerned, let me inform you that there are multiple duty structure in our country, and this leads to distortion in the market. There is different duty when you import gold and silver from UAE under SEPA Act, where there is different duty when you import gold from least developed country. There is different duty for refiners. There is different duty when you import LBMA gold or LBMA silver. So what we want is basically there has to be a structure wherein it is duty is clearly decided. Let me give an example. In case of silver, the duty under the SEPA agreement is only 8%, but duty under the when we import from the LBMA is 15%. So what we want is basically this big difference between the duty needs to be plugged. And so we are hoping that if the duty is reduced by 2 to 3%, or maybe 5% in silver, and similar case applies to the gold also, then I think the jewelry company will also start doing a better business, and it will bring the level playing field amongst all the jewelers and all the bullion dealers. And it will also lead to price discovery in the India International Bullion Exchange, which we are looking.
Mr. Mehta, I understand you have a long list of budget expectations this time around, but as you were mentioning, that bullion has various things to ask for, and then there are jewelry councils and diamond and various associations and councils as well, and everybody has a list of their own to put forth to Finance Minister. The only thing that I see, and I have some 5-6 of these lists, the only thing that I see common amongst all is the import duty cut. So we understand your point on that, that yes, it's not an even playing field, and that is something that everybody perhaps is vying for. The other really is about the taxes within India as well. We do understand that, whether it comes to the gold monetization scheme or sovereign gold bonds, we do understand that there are some taxes around that as well. And the other thing that the street is getting scared about is that until now, you have to show a PAN card if you buy jewelry worth 2 lakh and beyond. There are various reports that this amount could also be brought down.
Well, I'm sure that government will not look at bringing down that amount, at least that we are expecting. But as far as the taxation is concerned, what we expect is that the income tax on interest on sovereign gold bond must be cut, because that is not a big cost to the government. The interest given on sovereign gold bond is hardly 2.5%. So even if the tax is removed, it will encourage the senior citizen to invest in sovereign gold bond. And also we want capital gain tax on sale of gold and jewelry to be removed, because we have 25,000-30,000 tons of household gold, which we are not able to utilize because of fear of paying taxes and many other inquiries. And we keep on importing 900-800 tons of gold every year. So if in case this capital gain tax is removed, probably the government will lose in INR, but will save a lot of money in the foreign exchange, as our import will go down when we'll be able to utilize the household gold.
Mr. Mehta, IBX has been a great, establishment there. But, there are various regulators when it comes to bullion, gold, jewelry, etc. How do you at all see that changing? Because in the last few years, we've seen hallmarking and various hygiene measures being taken when it comes to this sector. But when it comes to Gift City and IBX and various regulators, do you see gold perhaps could be looking at a more comprehensive policy going forward?
Well, there are many regulators, as you rightly said: Reserve Bank of India, Commerce Ministry, Finance Ministry, DGFT, IFSCA, Consumer Affairs Ministry, SEBI. We have to deal with all of them, to bring in the policy which the industry is looking, which the consumer is looking. So in case only one regulator is kept, maybe IFSCA, which has been doing a wonderful job, that is India International Financial Service Center Authority. They have been doing phenomenal job. And if they are made the sole regulator for the gold industry in India, I think that would really help the industry.
Okay, all right, Manisha. Thanks very much for joining in and taking us through that conversation in the commodity space, talking about precious metals there. Well, we need to take a short break with the news that we have the market still in the red, the advanced decline ratio, which is favoring the declines at this point in time. We'll take a break, but up next will be Business Lunch. Stay tuned.